Every day, around the clock, a government facility in Washington, D.C., turns ordinary paper into actual U.S. currency. To meet the daily need for cash, massive machines churn out over $500 million daily. But here's something surprising. This printed money makes up just a small portion of the total money in circulation. Most of today's money is entirely digital, with over $4 billion added to that total each day. So, where is all this money coming from? Before it shows up in your bank account, it's passed through countless hands. Businesses, individuals, governments, and often, it was simply created with a few keystrokes. In this video, we'll break down how money is really made, how it powers the economy, drives inflation, and often puts people in debt. But first, let's rewind to a time before money even existed. The origins of money. Thousands of years ago, if a farmer needed a tool, he'd go to the local toolmaker. If he didn't have anything to trade right away, they'd strike a deal. The farmer would repay him later. Because the toolmaker trusted him, that promise of future value was enough. And sure enough, the farmer returned weeks later with produce from his farm. Eventually, people began trading in things everyone needed: grain, livestock, salt. These were valuable but bulky and inconvenient for trade. That's when metal coins came into play. Gold and silver coins were durable, portable, and valuable, making trade much simpler and faster. This allowed global trade routes to open between continents, connecting civilizations. But carrying large amounts of metal was risky and impractical. So, the next evolution of money began: the birth of banking and loans. In 17th century London, people began leaving their gold with trusted goldsmiths for safekeeping. In return, they received a paper receipt promising they could get their gold back whenever they wanted. These paper notes started being used in trade. They became as good as gold. Soon, goldsmiths noticed something. Most people didn't come back for their gold at the same time. So they started issuing extra paper notes as loans. Notes not backed by actual gold. They charged interest on these loans and made a profit without ever giving away their real gold. Say a goldsmith loaned out a note worth 100 coins. The borrower could spend it as real money, and when repaying with interest, the goldsmith earned more, without ever being 100 coins poorer. That one transaction created 100 new units of spending power in the economy, even though no new gold was minted. As long as everyone didn't demand their gold back at once, the system worked. Replace goldsmiths with banks, and paper notes with digital entries, and you've got today's banking system. How banks create money today. In the modern world, almost every transaction is digital. And surprisingly, banks don't just store your money, they create it. When you deposit money into a bank, the bank technically owes you that money. What you see in your account isn't physical cash. It's a digital IOU. When a bank gives someone a loan, it doesn't pull money from other customers. Instead, it creates new money out of thin air, just by typing it into a computer. The borrower spends that money, fueling the economy. Once they repay it, the money disappears. But the bank keeps the interest. That's how banks make money, and how money is constantly being created and destroyed. Money's ripple effect and inflation. Think about it. Someone borrows money to buy a car. That money goes to the dealership, whose employees then spend their wages on groceries, rent, and services. The money keeps moving, creating more economic activity. But if we keep creating more money without increasing the amount of goods and services being produced, prices go up. That's inflation. More money chasing the same or fewer goods. To prevent this, central banks and financial regulators try to manage how much money enters the system. The role of central banks and government bonds. In the past, banks could only lend based on the physical cash they held in reserve. Today, banks can lend far more than they actually hold. If a bank needs more reserves, it can turn to the central bank for help. The government, in turn, creates bonds, essentially IOUs that promise future repayment with interest. Banks, corporations, and even other countries buy these bonds. The money raised helps fund the government's spending on infrastructure, defense, public services, and more. But here's the catch. The government usually spends more than it collects through taxes. So, to cover the gap, it issues more bonds, going deeper into debt. To repay this debt, it relies on taxpayer money. In 2024, the U.S. government spent nearly $7 trillion, far more than it collected. So it created more debt to keep running, continuing the cycle. As strange as it sounds, this system of creating money through debt is how most countries operate. It's not necessarily a bad system, but it isn't perfect either. If newly created money were invested in things that generate long-term value, like education, infrastructure, and small businesses, the system could produce more benefits for everyone. Money is more than just printed paper or digital numbers. It's a tool, a system we all rely on, but few truly understand. Thanks for watching. If this video gave you a new perspective on how money works, don't forget to like, share, and leave a comment. Let us know. What part of the money system surprised you the most? See you in the next one.